And speaking of which, it's high time that I hand you over to said MC, the BTRM's founder, Professor Morad Chowdhury.
Mr. Dennison, good afternoon to you. Hello, everybody. Good afternoon to you all. Thank you very much for the far too kind introduction. Now, it's our pleasure to present this webinar today. And the BTRM, the Certificate of Bank Treasury Risk Management, has been talking about fairly mundane topics like balance sheet risk management and asset liability management for, gosh, nearly 10 years now. And every once in a while, the topic gets a little less interesting than perhaps it might be to certain people in banks. But then every once in a while, somebody comes along, for example, the senior executive and the board of Silicon Valley Bank, and then they remind us just how important these subjects are. So then we become the flavor of the month again. So that's a good way for me to kick off this presentation today. Nothing new under the sun. Silicon Valley Bank failure and lessons relearned. And for this, it's my pleasure to introduce our speaker, our presenter for today. It's Claire Trythall, who is visiting faculty at the BTRM, and she's going to talk us through this presentation. Talking through the background, the causes, picking apart as a case study, if you like, what happened to said Silicon Valley Bank. And after that, hopefully there'll be some time for questions at the end. As Mr. Dennison said, do please write any comments or observations in the chat, and we'll go through them at the end. Okay, right. So our speaker is, as I said, visiting faculty. She has over 10 years experience within the bank ALM space here in the UK at various institutions, looking to a certain extent, to a great extent, at interest rate risk in the banking book, but also other aspects of ALM. So I'm going to hand over to Claire. And Claire, thank you very much. It's our pleasure to welcome you for this presentation. Thank you for presenting it. Really appreciate it on behalf of everyone at the BTRM. I want to hand over to you. The floor is yours. And once you've wrapped up, please hand back to me and we'll have a conversation about it. Thanks very much, Claire.
Perfect. Thanks very much for the introduction. I think the title is quite interesting because it kind of refers to the fact that this is something that we've seen happen for like hundreds of years. So nothing new under the sun refers to the fact that this isn't something new. This isn't something that Silicon Valley Bank have done that nobody else has done before. We've seen it happen time and time again. So I'll go into that in the later slides. So just a quick fly through. I'm going to go into the introduction, the economic environment which led to SVB having a high level of deposits. So a lot of that was to do with COVID, and I'll explain why. And then I'm going to go into SVB's investment strategy. So what they did, although a lot of banks had the same level of excess deposits and they were all dealing with the same kind of thing, SVB took a different approach to what a lot of other banks did. And they had a different sort of ALM management strategy as well. I'm then also going to go into the options that SVB took. So because they hadn't hedged those bonds, it meant that they were in a situation where they had to start selling off parts of the bank. So I'll go into that in the later slides. So quick introduction, I'm not going to go through this too much because I think everybody knows the background. So Silicon Valley Bank collapsed on the 10th of March. This was following the fact that they tried to sell a portion of their bonds in the market. And because these bonds were sold at a loss, it raised alarm bells for shareholders. And a lot of deposit customers began to withdraw their funds, and quite rightly so. So I'll go into the economic background, which explains the excess funding and kind of what led to this sort of situation happening in the first place. So during the COVID-19 pandemic, there was a significant level of excess funds that gradually over 2020, 2021, 2022, there was a lot of excess funding in the market. So this was due to a variety of factors, which includes reduced spending. So people weren't having to go into the office. They were saving money on travel. They weren't going out for entertainment as much. So all of those kind of things just meant that consumers in general weren't spending as much. They didn't have as much that they could even spend their money on. So a lot of people were taking those excess funds and putting it into deposit accounts. The second thing that increased the excess funds in the market was the government fiscal policy. So, for example, in the UK, we had furlough scheme and business support loans. So those kind of government incentives directly increase the amount of cash that's in the economy. And the third thing is that in times of stress, there's a phenomenon where people tend to want to have a cushion. So it protects them against like not having any job security, not really knowing if they're going to be able to have the same amount of money that they used to have. So in order to combat that, we often see that times during a recession, people will tend to save more money as well. So all of these factors contributed to the excess levels of funds in the economy. So just to highlight that point, you can see Silicon Valley Bank is the blue line there. So although they had that large increase and it was kind of like steady from 2016 to 2019, and then there is a big jump up and that continues into 2020 and 2021. And I've compared that with JP Morgan, Bank of America and HSBC. And you can see they also had steady deposit growth until it got to 2020, where there was quite a spike up in the deposits. So it wasn't just SVB that was dealing with these excess deposits, but the way that SVB invested those excess deposits is unique to them. So this chart here shows you can see much more clearly that it was a gradual trend, and then suddenly there was a big spike up in their deposits. So they went from around 60 million deposits to almost 200 million deposits in the space of a couple of years. So you can see that that's quite a significant increase and is not really what you would expect from a BAU type of balance sheet. And you can also see in 2022, the total deposit starts to come down. So this is quite an interesting slide, which kind of explains what other banks were doing with their excess deposits. So basically, because these banks had a lot of excess funds, they wanted to look for a place where they could put these excess funds, because they didn't just want it to be sitting in like a current account and be making 0% on it, because rates were like near zero at that point in time. So what we saw was quite an interesting phenomenon where swap rates actually went up by 1% during 2021, but mortgage rates came down by 1% during 2021. So the reason for that is because all these banks had this excess level of cash and they wanted to invest it into a safe asset. So mortgages were seen as a safe asset, stable return. So they would rather invest in a safe and stable asset and just keep the cash sitting in a deposit account. So this is where SVB was quite different. So instead of looking to enhance their usual business operations and do more commercial loans type of thing, they decided that they were going to purchase some US agency MBS bonds, which is mortgage-backed security bonds. So the issue that they had with investing in these bonds is that they decided not to hedge them. So it's likely they might have behavioralized their deposits so that it was an offset, but in actuality, they didn't actually hedge them. So when it came to the point where interest rates increased, these bonds lost a lot of their value. So I'm going to go into an example with two repricing gaps. So in this situation, you're going to see how the difference between hedging and not hedging would have made a difference to SVB in 2021 and in 2023. So before rates increased and after rates increased. We don't have like the actual repricing gap, but we do know it was 110 million of fixed rate bonds that they invested in, and there was an average duration of around 5 years, but I went all the way out to 10 years, so there was fixed 10-year assets on the repricing gap. So we would have had a similar profile to this. So here's the 2021 example of the repricing gap, where you can see the assets are generating around 1.5%. The funding's costing around 0.5%. So without hedging, they would have made net interest income of 1%. On the other hand, if they had done hedging, there is a cost to hedging, which is why they wouldn't have wanted to do it. But you can see in the example with hedging that the assets, they're still getting the same 1.5%. The funding, they're still paying the same 0.5%. But they're now receiving 0.5% on the receive leg of the swap, but they're having to pay 1% on the fixed leg of the swap. So instead of getting a net interest income of 1%, they're getting a net interest income of 0.5%. So what we'll see in the next slide is what happens in 2023, where interest rates have gone up to 4%. So you can see here, this is the problem when you don't hedge your fixed bonds. So now interest rates have gone up and the cost of funding in the market is now 4%. So in the example where there is no hedging, the fixed assets are still only generating a rate of 1.5%, and they're only going to generate that 1.5% for the whole life of the bonds. So they'll generate that all the way out to the 10-year point, which is where some of the bonds were maturing. But now, in order to fund those bonds that are only giving them 1.5%, they're having to pay 4% for their funding. So that's why they've got that net interest income of minus 2.5%. And you can see on the right where we've got the hedging. It's a great example to show that when you do your hedging, your receive leg of the swap is going to cover that 4%. So although you've still got the same funding cost that it's going to be 4%, you've now got the receive leg of the swap is paying you 4%. So it covers your risk. So what that means is no matter where interest rates change, you've locked in that you've got that 0.5% net interest income. And this is a similar balance sheet structure to what we saw in the S&L sector during the 1980s. So there's a couple of different examples that are in the appendices if you're interested in looking at those. But it basically shows that this issue of asset liability mismatch, it's not something new, it's not something that was unique to SVB. It's something that's been known for hundreds of years, for as long as banking has been around. So there's many examples of banks not hedging, banks having fixed assets that reprice at a much later date than their liabilities. So I'm going to go on to now what SVB, the actions that they took in order to cope with the fact that they had such a negative net interest income. So their net interest income was now negative. Because they haven't hedged, they're constantly losing money. So I'm going to explain how, by not hedging their interest rate risk, it led to liquidity risk, which then led to solvency risk. So in SVB's situation, if you're in 2022, 2023, and interest rates have started to come up, there's a few options that would be available to you. So I've laid out the three options that SVB took here. And the issues with taking these options. But basically, in order to combat the fact that they hadn't hedged and they were receiving a negative net interest income, there's a few different things that they could do, but then there's caveats to what taking that decision might lead to. So the first option would be to not pass on the increase in interest rates to deposit customers. So where we've said that there's a 4% funding cost, we could say, let's not pass on that full 4%. Let's pass on 0.5% or let's pass on 1%. But the problem with doing that is that you're not incentivizing your customers to stay with you. So if you're not passing on a rate that's favorable for the customer, there's nothing to stop the customer from leaving the bank and going somewhere else where they are able to get a better return. The other option that they able to them was that SVB did have a portion of swaps that was much smaller than a normal bank would have. Like a larger bank would have a much greater proportion of swaps, the amount of assets that they've got. However, SVB did have a portfolio of swaps in 2020. And by purchasing these swaps, they were pay fixed of near 0% interest rate, but they were received floating, so they would have been receiving around 4% on these swaps. So because of that difference between what they're paying on the pay leg and what they're receiving on the floating leg, that means that these swaps are valuable and they're in the money. So by selling these swaps, you can make a gain on your capital and you can make a gain on your liquidity. It frees up your liquidity. However, it means that you're even more exposed to interest rates changing because you have even fewer hedging, you have even less swaps on your balance sheet. So it's more of a short-term solution that you can take. And the final option that they have available to them is to sell the fixed bonds that they bought. However, it would be the situation which is the opposite way around to the swaps. So because they purchased these bonds at a time when interest rates were near record lows, it meant that these bonds were not generating a significant yield compared to if an investor was to buy a bond in today's market. So if somebody was to buy this portfolio of bonds that's only generating a yield of, say, 1.5% when it could have been generating 5.5%, they're going to want to have a big discount. So that's going to take an instant loss to the capital for SVB. So if we go further into option one, so option one is the first option that SVB took. So they decided that they weren't going to pass on any interest rate increases to their deposit customers. This was in order to try and protect their net interest income. So they tried to keep the interest rates on the deposit accounts at minimum level, and they try and avoid passing on any rate increases. But what they start to see is a lot of their customers begin to leave the bank. They're not incentivized. They can go somewhere else. They can get a bond in the market at a much higher rate. So to be receiving only 0.5% from a current account, you can see why that led to a lot of customers beginning to move their money away. So this was just gradually to begin with, and SVB tried to combat this by increasing the rate on the deposit accounts to 1.5%. But it still didn't make much of a difference because the current market rate is around 4%. So going from 0.5% to 1.5% that's still not incentivizing customers enough. So if SVB had hedged, what they would have been able to do is they would have had that received 4% from the received leg of the swap. And they could have used that 4% either to pass on directly to their deposit customers to prevent them from leaving the bank, or they would have had greater options to raise new funding in the market at the current rate, which was around 4%. But because they didn't have that option, they had to fund those bonds that were only paying 1.5% with liabilities that were constantly leaving. So this led to a slow depletion of their liquidity as more and more customers began to leave because they could get a better interest rate elsewhere. And it also slowly began to deplete capital because now that they've increased the deposit rates up to around 1.5% to stop customers from leaving to solve the liquidity challenges, they're now having solvency challenges because by having a negative net interest income, it's slowly going to deplete your capital. So what is the second option that SVB did? Well, this is where they know that they've got issues with customers leaving the bank. They know that they've got liquidity challenges. They know that they've got solvency challenges. So all they can really do is look at those swaps that are in the money, and it looks like an easy win to sell those swaps, lock in that extra capital, not have to post collateral, so it frees up additional liquidity. So they take this decision to sell the swaps, which is during 2022. This gives them a gain on the capital because the swaps are in the money. So if you're looking at this from an economic value point of view, those swaps would have been worth more and they would have been more valuable, which means that when they're sold in the market, they're sold at a profit. And that's because it's the opposite of with the bonds. And that's why when you hedge and you have fixed bonds and then you have the swaps, that's why it protects you, because if your bonds lose money, then your swaps make money. And if your swaps lose money, then your bonds make money. So you have that offset on the other side. But what they chose to do was sell the swaps in order to lock in that gain on their capital and in order to free up some liquidity. Again, this is just a short-term measure, so it's not a long-term strategy. But what they've spoke about in their financial report in 2022 was that they tried to focus on net interest income rather than EVE. And the reason that they would have said this is because by focusing on net interest income, they can have a reason for shareholders for why they've sold those swaps. Because they're not going to come out right and say we've sold the swaps because they're in the money and we're having solvency issues. So that's why they also omitted from their 2022 report their EVE exposure, because their EVE exposure would have shown that they don't have any swaps, and it would have shown that they've got fixed asset positions going out to 10-year duration on the repricing gap. That would have caused a lot of sensitivity. And it would have meant that their EVE was flagging as there's a big problem for economic value here. So that's why they took the decision for the first time. They omitted the EVE results from their financial report. prior to 2022. It had been done every single year that they had their EVE results on the left and their NIR results on the right for their interest rate risk exposure. But in 2022, that was omitted. So as capital is depleting still, selling swaps provides a short-term solution, but it doesn't last long because the capital is still slowly depleting. These bonds are on the balance sheet for up to 10 years. So selling the swaps might provide a short-term solution, but it's not a long-term strategy. So they're stuck in the exact same position as they were. They've just moved it on by a couple of months and remained afloat for a couple more months. So this moves them on to option 3, which is what they did. So as interest rates started to increase again at the beginning of 2023, because they've already sold all their swaps and because their capital and liquidity is gradually and continually depleting, they had no choice but to sell some of the bonds. And this is the opposite to what happened with the swaps. The economic value on the bonds is negative because they're generating a low yield. So they've got bonds that are generating 1.5% when they could have been generating much higher in the market, which means the value of those bonds has gone down. So to sell those bonds, you have to sell them at a loss. So what SVB did was they got an offer from Goldman Sachs and they were offered to buy 21.5 billion of bonds at a discount of 1.8 billion below the book value. So bearing in mind that this is less than 25% of their overall bond portfolio, and given that their total equity was around 4 to 5 billion before COVID, it shows how much of a hit taking a 2 billion hit to capital is huge for SVB to only get rid of 25% of these bonds that are causing the problem. So if they were to sell all those bonds, it would have completely wiped out their equity and they wouldn't have had any equity at all. So their next solution was, in order to obtain additional funding, that they're going to try and raise 2.5 billion from the shareholders. So they went to the market and tried to raise more money from the shareholders, and quite rightly, the shareholders started to get suspicious, and this was what started to lead to the deposit run and a lot of speculation around SVB collapsing. If the shareholders had provided the additional funding, that would have only postponed the capital and liquidity problems that they were having further. As we've seen with the previous examples, they're just short-term solutions, and having such long duration bonds on the balance sheet, it's not a long-term solution to temporarily raise liquidity to keep you afloat for slightly longer. So in conclusion, SVB did do some significant errors in the efficiency of managing their ALM. So they shouldn't have purchased bonds without hedging. And that's the fundamental error that they made. And that led to them not having any room to increase the rate that they were paying to liquidity and deposit customers. And this led to them having challenges in terms of liquidity and capital. And it was gradual challenges over time, which wouldn't have been solved for many, many years. Because they didn't have any hedging, any action that they took was just temporary. So yeah, they would have continued to incur those losses over time. And the liquidity problems that they had were also exacerbated by the fact they were highly concentrated in tech. So with liquidity, when you've got your cash flows, you're looking to see where can I diversify my sources of funding, because you don't want, when one source of funding dries up, that you're left in a sticky situation. You want to be able to go to different sources and different places for funding, which SVB also didn't do because they were in the tech sector, so they were heavily concentrated in tech. They also had a lot of deposits that were outside of the 250k government guarantee limit. And a lot of these customers were more inclined to know each other because they were all like tech businesses and they all spoke to each other. So if they were saying that they've got concerns that you should take your money out of SVB, then that would spread like Chinese whispers, and a lot of people would start to take their money out and cause a bank run. So the problem with a lot of customers also having their total deposits outside of the 250k government guarantee limit is that their deposits are not protected. So this gives them even more of a reason to withdraw their deposits quite quickly, and be a bit more flighty. So if something happens, they're more likely to quickly take out their deposits rather than sitting and waiting to see what happens, or it might just be a rumour. They don't want to lose their deposits because it's not protected. So that's what made them more flighty and more likely to take their deposits out based on a rumour. SVB should have been transparent about the difficulties that they faced. Instead, their actions of selling off parts of the bank and concealing the problems that they were having with EBE from their financial statements shows that, in my opinion, it was a deliberate attempt to obscure information. So if you were a shareholder investing in SVB, I think to withhold that type of information from a shareholder is not giving them the full picture of the financial health of your business. Despite SVB being aware of the substantial and persistent issues with liquidity and capital that were stemming from their failure to hedge their bonds, they still tried to raise additional funds from shareholders. So those that were managing the bank would have known that by raising these type of funds, that it wouldn't have been a long-term solution. The only long-term solution that they could do would be to sell these bonds completely or to hedge them, which would have the same impact to capital. It would cost them more than the equity that they have available, so they didn't have that option. So banking's been around for centuries. Banks make money from maturity transformation and credit transformation. So it's nothing new in banking. Banks borrow short-term funding because it's cheaper, and they lend it out into fixed long-term assets because they can generate more of a yield on it. So that's the maturity transformation, is taking those short-term funds and lending it into long-term assets. But the problem is that some banks are not learning from the mistakes of the past. So we've seen the financial crisis. We've seen a lot of banks that have not hedged. We've seen the S&L crisis in the 1980s, and they all show the same thing, that if you have that asset liability mismatch, that if you don't hedge and you don't protect yourself and you don't have suitable risk mitigation in place, that it can lead to significant issues, and it can quite quickly lead to a collapse as well. So SVB acts as a cautionary tale for the banking industry because it shows what not to do. It shows there's nothing new to this situation. It's nothing new in banking to see a bank collapse because they haven't hedged. And it's nothing new to see a bank try to capitalise on their net interest income. So as I showed in the earlier slides with the repricing gap, you could see that they made that extra 0.5% net interest income by not hedging. But is it worth it when interest rates go up and all of a sudden you're losing 2.5% every year? In my opinion, it's better to hedge and lock in that rate that you get between your assets and your liabilities, and then you're safe and you're stable, and no matter what happens with interest rates, you know that you're protected and you've locked in that margin. Whereas by not hedging, you could potentially face infinite losses. You don't know how high or how low interest rates are going to go. So when you're a banking book, especially like SVB was, a banking book shouldn't be trying to take risks on the markets. So by purchasing those bonds and positioning themselves for a rate down scenario or a stable rate scenario, they were taking a position on the market and saying that we don't think interest rates are going to go up, so that's why we're not going to hedge. And for a banking book, they shouldn't be doing that. They should be making money from the commercial loans and the difference between what they get on their assets, which is the commercial loans, and what they pay for their deposit customers. It shouldn't have been trying to profit from treasury assets in the market. So further reading, this is a quote from Warren Chowdhury, who introduced at the beginning. And this is a post that I've put on my LinkedIn not long ago. It kind of just emphasises the fact that when you're working in banking, there's certain morals that you have to uphold, and you always have to be thinking about what's best for the customer. So the quote says, "The profession of banking is an honourable one. To be given a responsibility at any level of a banking institution is to be entrusted with a valuable part of society's well-being." I think that's a really good quote, because when times are good and when the bank's making money, it's kind of the management that profit off that and they get their big bonuses. But when things go bad and they have to be bailed out, then it tends to be the public that bears the burden of the bailout. And then I'm just going to quickly fly through these appendices so we've got some time for some questions, because I can see a lot popping up. But this is just some typical examples of what happened. So we can see the 1980s, same as the loan sector in the US. That was very similar with the asset liability mismatch. So because interest rates increased, then the amount that they were paying for their funding was more than what they were getting for their assets. In the 1930s, a similar situation, and that contributed to what happened in the Great Depression. So again, you can see these examples, they go quite far back and they're across hundreds of years. So that kind of like wraps up nicely to the title of the presentation, which is there's nothing new under the sun. This is all stuff that we've seen before. We should learn from the past and we should seek to implement good risk management and practices that ensure that these type of situations don't happen again.
Okay, thank you. Can everybody hear me? All right, thanks very much, Claire. An exceptionally fine run through of the failure of Silicon Valley Bank this month, and by fine also reads succinct in its brevity, but its focus. Could I just ask quickly, before we go to the questions, could I just quickly ask you to go back to slide 21? I just wanted to point out on the 4th bullet point there, what we, the BTRM, are saying, including you, what we're saying is removing that EVE number suggests possibly a deliberate attempt to obscure information, but of course, we have no idea if that was actually the case. Okay, so if anybody is listening out there who represents that failed institution, we are not saying that it was any deliberate attempt to obscure information, but the implication can be hinted at without any accusation actually being leveled at any of the executives. Right, okay, great. Always got to cover one's disclaimers before one speaks publicly about anything. Now, I have a comment. Actually, before I get to the question, we have one comment there so far. Do we have plenty of time on this session, guys and gals? So if you want to write in, do please please write away. I just wanted to ask you, Claire. Thank you for that. Very helpful, very useful, very informative. Would you say that? What would you say to an argument that even if a bank had got the interest rate risk wrong, the hedging wrong in the way that they did, which you've explained very, very well, but they had a less concentrated funding structure? You had a chart that showed how much of their funding was instant access deposits. You had a metric that showed that they had a very low interest cost charge, which implies that much of that very high non-interest bearing was instant access. Okay, if an institution had carried on making those interest rate risk hedging mistakes, but they'd got the funding right, they didn't have so much of their funding in instant access. They had more term deposits, they had more notice accounts, they had more deposits from customers that weren't institutions, individuals, not high net worth individuals or institutions, just you and me, regular people. Would you say that they would have survived the capital losses of the rates hedging mistake and been able to save themselves, or was it purely the rates mismanagement, the rates exposure mismanagement that led to their demise? What if someone was to say that? What would you say in response?
I would say it's a bit of both, because say if they'd invested in term funding, they wouldn't need to hedge because, for example, if they've got 5-year liabilities that are fixed, then they wouldn't need to hedge those bonds because they could have had a profile of term funding that would act in the same way as hedging would have. So if they had a better mix of their funding, whether it's in term or whether it's different countries, different sectors, it would have helped avoid that bank run type of situation, because it wouldn't have been so heavily concentrated. But I think perhaps the reason that it was all the one type of funding is because that was the cheapest type of funding. But the reason that that is the cheapest type of funding is because it can leave very easily. So I think if they had a better strategy in terms of investing in term deposits or notice deposits, it would have meant that there wasn't such a significant impact of having a bank run. So it could have helped, especially if it was fixed deposits, because they work in a very similar way to hedging, where if the value of the bonds has gone down, then the value of their fixed liabilities would have gone up.
Understood. Of course, yes. I don't disagree. I mean, I wasn't speaking of completely matching. I mean, if I'm buying 5, 6, 7, 8 year expected life bonds, I'm not going to have that tenor of funding. But even if some of my funding is, has a 60 days notice to withdraw, or it's 6-month term deposits that I roll over to retail customers, I'm not addressing the interest rate mismatch in the way that your chart showed, but I'm addressing the funding concentration, aren't I? Which you've just quite rightly pointed out, the concentration by customer type, concentration by tenor, which for me was their ultimate undoing. But I think you are suggesting that the original sin, well, there's no doubt about this one. The original sin was the rates exposure not being addressed, managing to the interest income, trying to maximize that, the NII metric, rather than keeping an eye on that as well as the EVE metric at the same time. I suppose you're saying that, and that original sin was so great because of the magnitude of it, the large number of bonds, that possibly even having a less concentrated deposit structure or funding structure may not have helped them. Yes,
Yeah, because basically, because they haven't hedged, they don't have that rate that they can pass on to customers. So by not hedging, they're not having that 4% receive leg on the swap that they can then use to find 4% funding in the market. So if they had the ability to pass on that rate from the receive leg of the swap, then it would give them more options when it comes to funding. But because they hadn't done that, they were kind of stuck with those deposit accounts. They couldn't invest in term funding because it would have ate into their net interest income.
Okay, all right. And I know you'll begin to that analysis. What about if they just chose to just take a lower net interest income, not hedge the bonds, but just put more expensive funding on, less concentrated, and just run lower P&L from one year to the next? That also would have helped them, right?
Well, they were, but the reason that they couldn't continue to do that was because slowly it was depleting their capital. And this is why they had to sell the swaps in order to top up their capital, because it had dropped to a certain point. But because these bonds are such a long duration on the repricing gap and they go out to 10 years, you can use these solutions to help in 2022 and 2023, but you've got potentially another 8 years of having to do that where you're running a negative net interest income. It's not sustainable, and they've already sold off the parts that they can that were in the money, and it helped them survive maybe an extra year, but it wouldn't help them to survive for the 8 years that they're on there, because it would just continue to deplete capital over time.
Okay, thank you. Thank you very much. Right, now we've got one comment so far. I was expecting tons of questions. So far, I've only got one comment from Simon Vuko. Thank you very much. The second last point, and I think that's on slide 21 as well, I think. I'd say it's the industry's responsibility post-2008 that the public does not bear that burden. Claire, what do you make of that comment? I can't disagree, personally.
Yeah, I think the issue is that if the public bears the burden and banks know that the public's going to bear the burden, then you've got those issues of moral hazard where people are managing banks and they know that they can take excessive risks one way or another, position themselves for a rate down scenario, for example. And they know that in a situation where if rates go up and they make a lot of money, they're going to get a great bonus. Whereas if rates go down and it costs a lot of money and they collapse, then it doesn't matter because the public's going to bail them out. So it's kind of like you've got that moral hazard where they would personally gain from the decisions that they make, which is why using the public to bail out the funds isn't always the best option, although it is usually cheaper than allowing the bank to fail. But because of the issues of moral hazard, it's kind of like you need to teach these banks a lesson. The public aren't always going to bail you out if you take those kind of risky decisions.
Yeah, absolutely. Yes, quite right. Moral hazard has been debated since then. Although at this point, there's no suggestion that the public purse is being impacted in the US. Now, in the UK, do please write in any comments or observations. If you thought the presentations made perfect sense, that feedback would also be welcome.
Have you scrolled down more?
In
There are
the
many
UK
questions.
Okay, there's something wrong with me here then. So what am I missing on? Oops, sorry, as you were. They're not coming up. My screen froze. Thank you for telling me that, Mr. Dennison. No, it's okay. I can see them now. Bear with me 1 second. Yes, it froze. And that's BT broadband for you. Bear with me 1 second. Right, it's coming. Here we are. Okay. Colin Johnson. Thank you for your comments, sir. Appreciate the focus has been on IRBB, but why do you think they didn't explore other avenues, for example, Repo? Any thoughts on that one, Claire?
To be honest, I'm not really in like the Treasury Instrument space, so I don't really know that much about repos. So it's probably better that you answer, Morad.
To be honest, I've been asked that quite a few times already. Thank you, Mr. Johnson. The honest answer is I have no idea. Possibly the haircut they would have got on those bonds, having dropped in market value, would have made the funding source by doing so not sufficient for the outflow they saw. That's my surmise. I don't know why that wasn't an option, but my surmise is there wouldn't have been the value, given the lower value of those bonds compared to the notional, to raise through the repo market, and it wouldn't have plugged the outflow they were seeing in funding. That's my surmise. Okay, the next one is from Calvin. Thank you, sir. Given SPV was exempt from LCR and NSFR reporting, this is US regulatory rules, given its size, how exactly did they go about assessing how much liquidity risk they were sitting with given this mismatch?
I think this is a problem because the US banks, the regulation for the US banks has been quite lax, and that's why it's led to a lot of these issues. I think measuring the LCR and the NSFR, it wouldn't have necessarily protected them because these issues were fundamental issues that were going to deplete their capital and liquidity slowly over time anyway. It might have allowed them to see it earlier, but it didn't mean that they could take any action off the back of it. But it's interesting to note as well that SVB didn't have to follow any regulation in terms of recovery and resolution planning either. So when it came to the time when they did need to take action, they didn't have any kind of bail-in debt or anything like that that might have actually helped their position until it was too late. So yeah, that's kind of, the regulation does help, but you can't really rely on the regulation. It's more about doing like best practice and knowing that you've hedged and you've protected the bank, and then the regulation just kind of confirms that, and those metrics just confirm that.
Couldn't agree with you more. Absolutely. If they didn't have to report it, that's true, but that's no excuse for not following good practice. Now, LCR, the next question leads on from this, actually. By the way, I'm not sure NSFR would have helped them. I mean, NSFR is in a set of assumptions divided by another set of assumptions. So I'm not sure, even if I had reported it and been compliant for it, would have helped them in this situation. LCR, possibly. Now, the next question is from Mattia Cesana. I hope I've pronounced your name correctly. Thank you for the comment. Even if they had to report LCR, was the indicator able to predict the bad situation? I guess LCR was still greater than 100%. Claire, any thoughts on that?
Yeah, I think it would have just allowed them to see what they want to see, because in my opinion, it seems like a lot of the metrics that they were looking at were kind of hiding the issue. So by selling off, like for example, selling off the swaps and selling off different parts of the bank, it might have made their liquidity metrics look really great, because after selling the swaps, they would have had injection of liquidity, and they would have had a lot of cash from the profit that they made from selling swaps. So those metrics wouldn't really flag those kind of things, and it might say that you've got quite a significant level of liquidity, but it's actually because you've sold something on the balance sheet.
Okay, thank you. Robert Chiobanu, I hope I've pronounced your name correctly, sir. They should have additional tools for measuring liquidity in such cases. Well, couldn't agree with you more. Again, what did banks do to manage liquidity before there was an LCR? You know, what did banks do 50 years ago, 100 years ago to manage maturity transformation risk in the way that they always have done? Quite right. It's even the fact that they weren't obliged to report an LCR minimum doesn't absolve them of the fundamental errors in it when it came to managing liquidity risk. Jafar, thank you. He's thanking you, Claire. You're very welcome on her behalf. David Cartella, hello, sir. Could you confirm that hold to maturity portfolio cannot be hedged with an IRS, as accounting methods in HTM and AFS are not the same? Do you want to take that one, Claire?
With the HTMs,
Is it me?
Oh, no, she's dropped out for me as well.
Okay. Okay, she'll come back in a second. I mean, I'm not sure that's the case. In the European Union, the entire balance sheet is assessed for EVE exposure based on interest rate repricing. So if the EVE number is higher than 15% of Tier 1 capital, you're obliged to either put up Pillar 2A capital or reduce that sensitivity with matching funds or interest rate swaps, or a mix of both. So I don't think it's the case that one couldn't hedge it with a swap. I mean, it's not just the AFS portfolio that's subject to Basel guidance on interest rate risk. Matt has said, brilliant, Claire, thank you. So on her behalf, may I say you're welcome. Wait, hold on, sorry. The next one is from Della. Thanks for this. You're very welcome. Robert again, thanks for presenting. You're very welcome. Edward, very welcome. Thank you. Okay, the rest are Peter Kimani's asking about the slides. Ed, you'll be sending them very shortly after this presentation. You've answered that. KR, it seems SBB didn't breach any laws with the non-disclosure on the EVE side. Are you suggesting disclosure would have been a solution? Couldn't that just have precipitated a run sooner? Claire, your thoughts on that?
My thoughts on that is that just because it's not technically against regulation to omit their EVE doesn't mean that there's not a problem with it. In my opinion, to be the first year that they've omitted their EVE from their financial report shows that they knew that there was an issue. I can't understand any other reason why you would know that you've got an issue with not hedging your bonds and you would have significant capital and liquidity issues and you've sold all your swaps. It just seems too much of a coincidence to me personally to omit your EVE when your EVE would have been the metric that would be flagging that you've got serious exposure to interest rate risk.
Okay, thank you. Nyasha John, thank you for your comment. To what extent can we question the liquidity stress testing procedures at SVB? Were the events leading to the demise of the bank unforeseen to warrant potential non-inclusion from stress tests?
I think that they would have seen that these kind of liquidity issues were coming, and I think that it's been a long-standing issue for them that they've been dealing with since interest rates started to increase, so in probably around a year. So it's not a surprise for them that they all of a sudden started to have liquidity issues, because in my opinion, that's the reason why they took the actions that I've laid out in the 3 scenarios in the presentation. They wouldn't have needed to sell the swaps, they wouldn't have needed to sell the bonds, and they wouldn't have been increasing the rate on the deposit accounts if they didn't think they had any issues with liquidity.
Okay, right. So Simon Buka, you've commented, what about deposit insurance? I wonder if you're implying that the moral hazard there in not observing the cap on that is an issue. But otherwise, if you want to elaborate further, please do. Varun Agarwal, could they have had a better strategy on the asset side? Rather than parking all the money in fixed rate bonds, they could have deployed it across different maturity buckets or in floating rate bonds. Claire?
Yeah, I think they didn't have any need to invest in these fixed bonds, in my opinion. They should have kept it in the cash account. If they looked into economics and they knew that a lot of like fiscal policy was being conducted by the government and a lot of cash injected into the economy, then they would have known that these deposits are temporary. So from an economic point of view, they would have known these deposits are temporary. From an ALM point of view, they shouldn't have been putting bonds into a fixed bucket without a fixed offset in the liability bucket anyway. So either way, if it was me that was doing it, I would have kept the cash in the overnight bucket and just kept it in a current account.
Okay, thank you. KR, what if they had a much higher capital buffer to absorb losses on the HTMs? Would that have been a part of the mix of solutions as opposed to a purely hedging strategy, considering some banks don't see it as economical to hedge?
It would have still just delayed the inevitable. So the total loss in the bond portfolio was more than the amount of equity that they actually had available. So they would have to have a capital buffer, which is bigger than their actual value of equity itself. So it wouldn't have made a difference over the life of the bonds. It might have helped in the first year to keep them afloat for slightly longer. But it wouldn't have made a difference in the grand scheme of things. They still would have collapsed in the end.
I mean, the whole point of the Basel guidance on interest rates in the banking book is to assess your EVE risk. And then if it's greater than this 15% hard stop, have capital pillar 2A capital specifically for that. So the idea being if there's a shock scenario, 200 basis points in G7 currencies, 400 basis points in some other currencies I'm familiar with. When there's a shock scenario, you've calculated approximately that impact and you've got the capital for it. So in theory, that should be there. But I suppose maybe there's a rethink demand for that. Simon, you've come back and very clear. They had 97% or so of customers not covered under the FDIC insurance. Exactly right. Now the FSA had an excellent term for it. In the old days, pre-PRA, the FSA termed deposit types into 2. Corporate deposits, large corporates, or the larger of the SME corporate deposits were viewed as type A, unstable, so had a high outflow assumption under the old ILA regime in the UK. This is pre-Basel III. Whereas retail customers, mom and pop, to use the American expression, would have been type B, more stable behavior assumed under a stress. So by the same token, if there's a balance that's below the government guarantee, one can view that as what I would have called type B in the old days. So that's also concentration of funding factor that Claire pointed out. Okay, right, what's next? That is a flight risk in itself in a stressed environment. Absolutely, Simon, agreed with that. Guy Coleman, would bonds hedging have prevented the outflow of deposits of the customer? Good question. I'm going to turn back around the original Sinclair. Would hedging the bonds have prevented the outflow of deposits?
In my personal opinion, yes, because if you hedge those bonds, then you would be getting a receive on the swap of 4%. So even if you just went to your deposit customers and every time interest rates increased, you passed that receive leg of the swap straight onto your deposit customers, then you would be giving them a very favourable rate compared to the market rate. So that means that they would have an incentive to stay with the bank because they know that the rate they're getting on their account is more favourable than anything else they could get. So whether they would directly pass that rate on to deposit customers or they could use that receive leg of the swap to get new funding in the market, I would still give them many more options for their funding and they wouldn't have had to maintain the deposit rate so low, which is what led to customers leaving to get a better rate elsewhere.
Okay, thank you. Varun Agarwal, HTM cannot be repoed out, I believe. It differs across jurisdiction. That's not my understanding. In the UK, the accounting treatment of an asset on your balance sheet is not, in the first instance, prevent from you putting it up as collateral. So whether it's a payments agency or under a repo. So I don't think that's correct. Not in the UK anyway. I mean, I stand corrected if I'm wrong, but I don't believe that's the case in the UK. Jero, and thanks for the presentation. You're very welcome. ACM can be repoed. Thank you, Robert, for confirming that. Just at a haircut. All repos at a haircut. When I was doing gilt repo when the market first came about in 1996, that's right, long time ago, last century. Gilt repo from that's Claire's thinking, wasn't I in school then? 1996 gilt repo. I remember even gilts had a very small haircut. AAA, 1-2% in those days. Maybe it's changed now. So there's always a haircut. Quite right. Now, Jafar Benkirani, I hope I pronounced your name correctly. Thank you for the comment. Does SVB case highlighting the lack of combination between liquidity and interest rate metrics and advise regulators to do so? Well, do you follow that question, Claire? The interplay between liquidity risk metrics and interest rate risk metrics.
Yeah, I think in my personal opinion, there's a lot of connection between the interest rate risk metrics and the liquidity metrics. And in my opinion, if you don't manage your interest rate risk, it's going to lead to liquidity problems. And then your liquidity problems are going to lead to solvency problems. So I think all three, like solvency risk, liquidity risk, and interest rate risk, I think they're all interconnected.
I liked your slide with the 3 green boxes, rates, leads, liquidity, leads, solvency. To be honest, I would have had them coming in angles into the solvency one, okay? But let's not a little professional disagreement like that spoil the day. No, very nice slide there that just showed that interconnection of the 3 boxes that you showed earlier. Simon Vico, a case study of the recently failed SVB bank is illustrative. Absolutely. I hope you found this presentation today helpful. Monetary tightening in US bank fragility in 2023, mark-to-market losses and uninsured depositor runs. Oh, yes, you're giving a quote on that, March 13th. Oh, that's great. Thank you for that reference. I appreciate that. Thank you very much. UK and European banks have significant excess liquidity with an average LCR of 147 and 146, well above regulatory minimums and significantly above the US banks average of 119. Let me take that one, Claire. I don't know about European banks and such, but in the UK, I remember talking to one of the partners at the Big Four firms a couple of years ago, in the UK, and this is one of the Big Four firms that is in the happy position of doing business of one kind or another, whether it's internal audit, external audit, or advisory work with just about every bank in the UK. And this chap was telling me that LCRs in the UK ranged from 150 odd to 850 odd, and the average was much higher than that's reported. The average. Now, he may have had a biased view on just his client base, but LCRs are much higher in the European Union than elsewhere. That's correct. Ahmed Al-Safi, thank you for the comment. Do you think more frequent NII EVE reporting is necessary? Yearly disclosures don't seem anywhere near as often to be insightful. Claire?
It depends which bank you look at. So I think the normal amount of reporting for EVE and NII in the UK anyway would be at least monthly, but you would probably look at it intra-month as well. So if you needed to do any hedging on new business that came in during the month, that you would be able to do that. So it might be reported in the MI monthly, but it's likely the ALM team are looking at it more frequently. In the case of Credit Suisse, they looked at their NII monthly, but they looked at their EVE daily. So that's just an example of how much a bigger bank would be managing their EVE more regularly. Whereas if you're a smaller bank, you might not have the capacity that you can model those kind of things every single day.
Okay, thank you. Manoj Matala, is there any limit in the US on the proportion of assets that can be booked under HTM? For example, in India, the max is HTM proportion is about 25%. I dare say we need an accountant to confirm that. I wasn't aware of that. I mean, there's no reason a bank can't have 100% of its asset booked in HTM, can't it? I mean, there's no reason to hold an AFS portfolio except your HQLA. But I'm afraid I don't know the answer to that under specific accounting jurisdictions. Now, here's the $64,000 questions from Bella Dumbuya. What could SVB have done to anticipate? I believe you know what he's referring to there, Bella, or she, forgive me. What could they have done? Very quickly, Claire, what should they have done even 6 months ago, or was it too late by then?
By 6 months ago, it was too late. What they should have done is if they're purchasing treasury assets, then they need to be getting the swap at the same time. They need to be doing the hedging at the same time because then they've locked in that risk. Even if they were to just wait a couple of weeks between when they buy a treasury bond and when they hedge, even that's like a slight bit of interest rate risk. You don't know where rates are going to go in a couple of weeks. Whereas if you take out your hedging at the same time as you buy those treasury bonds, then you know you've locked in a certain amount of your net interest income and you're not exposed to rates going one way or the other.
Okay, yes, thank you. Now the question there actually though is just they hadn't had a CRO for about 8-9 months. They hadn't filled that position, from what I read in the papers. I mean, what can one believe in the papers, right? But just imagine if you had been appointed as CRO, 8 months ago, would it still have been too late to do anything? Claire? Did you hear that?
Sorry, I think my computer crashed for a second there. Can you just repeat that last sentence, please?
Just imagine you had been appointed, because they didn't fill that CRO role for about 8-9 months, I understand. Just imagine you had been appointed 8 months ago. You're saying it would have been too late. The damage was done. Yeah.
Yeah,
okay.
yeah. The damage was done. The cost that they'd incurred from not hedging was already greater than their equity. So no matter how you dice it up, whether you look at it at a certain area of the balance sheet and how much it would cost to sell the bonds, or however you look at it, the losses they'd incurred from those bonds were greater than their equity. So there was nothing that a CRO could have done coming in at that point in time.
Okay. The original sin was there, fully baked. Right. Chi Chen, thank you for the comment. It would have been interesting to see how SVB categorized the surge of deposits during 2020, to see how much was structural or stable versus excess during low rate environment. Perhaps if they had recognized a large portion as excess, then these would not have been invested in long duration bonds. More scrutiny should have been performed before investing the surge of deposits. Absolutely right. I couldn't disagree with that. I mean, that's as Claire highlighted in the presentation, much of it went into higher yielding securities when fixed rate, when that needn't have been the case. Lax Sishan, thanks guys. We don't have much information about SVB UK. The UK Limited is ring-fenced with its own capital, liquidity, and potentially under PRA regulations. Once the parent is in trouble, it would be very difficult for the subsidiary to survive. It's a classic Isla idiosyncratic stress scenario. What else SVB UK management would have done? Now, that's I'll take that, Claire, if I may. That's a very good point about SVB UK. That's an interesting story, and in due course, let's have another discussion about it once we know more information. It was, in theory, according to a post by its CEO on the website on the Thursday, they had plenty of capital and liquidity, and they weren't going to be impacted. Friday, that notice had been taken off, and Monday, it's been bought by HSBC for £1. My surmise is that the Bank of England just didn't want to have any contagion effect, no matter how, unrealistic or unnecessary. They just wanted to nip it in the bud. I mean, from what I see of banks like HSBC, for many years now, they've been trying to offload non-bank FI type customers, fintech deposit customers, digital banks, challenger banks, crypto companies. They've been trying to offload those. I'm not entirely certain that it's part of their strategy. They would have wanted to take on a whole load of that customer base, but that's my surmise. I mean, the fact that they bought it suggests that I'm wrong. But with that one, yes, they didn't go into a recovery. Robert Chibano, why SVB is not part of resolution planning on regulatory level? Practically, in their case, if they had a resolution plan which has all indicators included, liquidity and IRRB inclusive. There is a large framework of thresholds and limits. If such a framework had been put in place, they would have been obliged to create an action plan. Risk appetite framework exists for such cases, and it is strange for a bank not to be able to manage it. That's a very good observation. Quite right. It's interesting how in each of these three cases, Credit Suisse now, I chuck in as well, there's no recovery. They went straight from stress to resolution. You know, banks for the last 10 years, banks have been writing 200, 300, 400-page documents on recovery plans. And if the minute things get a little bit hairy or a little bit hot under the collar, a little bit hot under the collar, we go straight to resolution. I'm wondering, you know, what's the object of the recovery plan? But that's a good point you make. Indicators, Robert Chibano, besides these indicators should be reported on monthly basis on their ALCO. Quite right, absolutely. But the SVP deposit profile wasn't so flighty for rate-sensitive reasons since they had lots of relationship deposits. Funding mix is another. Yeah, I'm not sure it was relationship deposits. I mean, as Claire pointed out, you know, they were what we'd call in the old days type A. They were, at least theoretically, unstable in that were large corporates. I think we've got time for just one more and then we'll knock it on the head. Thank you for all these comments, everybody. I really appreciate it. Pedro Bonoquez, thank you for the presentation. You're very welcome on Claire's behalf. Any additional thoughts regarding the concentration on the deposit side, fintech industry? Could this lead to new regulations that force the banks to a more granular management of the deposit base? Claire, do you want to take that?
Yeah, it's always important to diversify your funding and make sure that you're not relying on one source of funding. But a way that you could get around that if you didn't have any other option would be to invest in fixed term funding, because then they don't have the option to leave even if they wanted to. So as long as you diversify in one way or the other, yeah, it's important so they don't all leave at the same time and there's a bank run.
I mean, in the UK, we do have this concept called Pillar 2 liquidity. The PRA did a policy statement from 2016 which addresses all those liquidity risk types that LCR doesn't cover. It does address concentration, either concentration by customer or tenor or type of product. And if the concentration is deemed excessive, there is a greater HQLA requirement. So in the UK, we have this concept of Pillar 2 liquidity. It's not universal, though. I mean, perhaps that's something for national regulators to look at. Okay, Babu Satya, how is CSRBB different from IRRBB? I'm afraid that's a topic for another webinar, my friend. Credit spread risk in the banking book, you are quite right. It is part of the guidance on IRRBB, but that is for another time. Okay. According to US, Tiago Vinati, according to US regulators, the embedded loss EGL is the available for sale bonds does not impact the capital. Basel index of the institute, because this could lead to a breach of capital before selling of FS bonds. Okay, unfortunately, we've run out of time to do that one. That's a very good observation to make. Sounds like the bank should have been wound up long ago. Okay. So, KR, that's perhaps right. Okay, and I think we are now at time. Thank you, everybody, for all those. Jason, you're very welcome. Thank you for all those observations, everyone. Silas Ogada, with market risk, you lose a fortune. With liquidity risk, you lose the bank. Very good point. Or as my old friend Colin Johnson was always saying, capital kills you slowly, but liquidity kills you on a Sunday afternoon. Okay, right. And Charlotte Powell, thank you for your comment. You are very welcome for the informative session. Thank you, everybody. We are at time. I'd like to pass on my great thanks to Claire for this fantastic presentation. Excellent, succinct summary of SVB. Nothing new under the sun. They did make some good old-fashioned mistakes, which sadly people, you know, individuals connected, direct stakeholders are now suffering from. Claire, I really appreciate it. Thank you very much for that. Welcome to the BTRM faculty, even if it's on a visiting basis, but maybe we can do something about that. To everybody out there, the slides will be with you, the recording will be with you. Please stay in touch. Look out for our next webinar. Thank you for your company this afternoon, and I wish you a good evening. Take care. All the best. Bye-bye.
Thanks for having me.
Right, lovely. Thank you very much, Claire and Morad, as well as all of you for attending. We'll be sharing the recordings and slides later, and if you're watching on YouTube, then check the description for those slides. If you have found this interesting or essential, then you can find us on LinkedIn and YouTube, or if you want to become the authority on all this, then please do pop to btrm.org, where you can sign up for the Bank Treasury Risk Management Certification course. It is a postgraduate level program and is endorsed by the University of Applied Sciences and Arts, Northwestern Switzerland, based in Basel, no less, and we conveniently enough have a cohort starting in April. So with that, I will thank you all again and leave you to your days. Goodbye.